Okay, let's use Excel to calculate internal rate of return. So I just did this problem with net present value a couple minutes ago. I'll run through it again real quickly. So a new packaging machine is costing $100,000 and they're including installation. It has an estimated useful life of 5 years and an estimated salvage value of $6,000 after 5 years. The new machine will be purchased at the end of 2010. Installation and use of the machine will result in labor savings over each of the next 5 years. So here's our projected labor savings. Firm's cost of capital is 16%. So we are being asked to calculate the internal rate of return. So I'm going to add one column to this to include the outflow of cash required at the end of 2010 for $100,000. I need to change this because it's coming up as a percent. So let's format cells. And just do a number. Okay. Now we've got our $100,000 cash outflow in 2010, $26,000 cash saved or inflow in 26, 27,000 in 2013, 31,000, 35,000, all the way down to 2015, where we had the $38,000 cash saved plus a $6,000 salvage. That's money the company will get back when they sell the equipment at the end of its useful life. Now we can use Excel to calculate the internal rate of return. So we'll come up here to Formulas, Financial, and go down to IRR for internal rate of return. And it gives us a nice box here. This is one of the easiest calculations you're going to do. All you have to do is come over here and highlight all of those projected inflows and outflows over the years. And then I hit enter. So okay, it gives me a return of 17%. I can also expand the decimal places here, get something a little bit more precise. So 17% is the internal rate of return. So this is how much they expect to get back as a return on their investment over the years using, well, this cash inflows and outflows. Their cost of capital is 16%, so they're going to get more back than their cost of capital. This would be a good project, or an acceptable project anyway, that they would want to consider because they are getting a higher return than what their money is actually costing them.